right now, if you glance at the global markets, it looks an awful lot like everyone is just popping champagne.
Oh, absolutely. It's a party out there.
Right. You've got this massive AI tech boom making front page headlines daily. And there are these, loud, persistent hopes for geopolitical peace dominating the news cycle.
Yeah, the optimism is everywhere.
But if you look just beneath that very noisy surface, the actual foundations of the global economy are, well, they're quietly being dismantled. And the detail that really stands out the most, they are being dismantled by the very governments that originally built them.
It's a completely fascinating divergence to watch unfold.
Mm.
Because, the biggest mistake people make in financial analysis, or frankly, in any kind of strategic planning, isn't mispricing a specific stock or asset.
Mm-hmm.
It's this dangerous assumption that temporary economic guardrails are permanent, indestructible structures.
And that brings us to our mission for today's deep dive. We are looking at this incredibly dense, highly revealing dispatch on sovereign credit. It's titled The Admission Cycle.
A very fitting title, honestly.
Yeah, and our goal today is to look past all this noisy deal optimism you're seeing on your feeds and really uncover the quiet structural admissions that major countries are making right now about their broken economic frameworks.
Right.
It kind of reminds me of buying a house. Imagine you're completely obsessed with the new AI-powered smart home features.
Oh, yeah, the light's turning on automatically, that whole thing.
Exactly. The fridge is ordering your groceries. It feels like the future. But you are so focused on the tech that you completely ignore the fact that the previous owner just publicly admitted they took a sledgehammer to the load-bearing walls in the basement.
That is a perfect way to look at it. The smart home features are the headlines capturing everyone's attention right now. But the missing load-bearing walls? Well, those are the structural framework retirements happening right now in the sovereign debt markets.
Wow.
And to really understand the risk, we have to look at why everyone is so hyper-focused on the smart fridge in the first place.
Right. Let's start right there with the distraction itself, because the dispatch points out that the dominant frame right now is deal optimism. And, to be fair, the distraction is incredibly convincing.
It really is. It's grounded in real data.
Yeah. You have Secretary Rubio signaling there are solid signs for a U.S.-Iran agreement. You've got U.S.-China trade talks back on the agenda at the APEC summit. And just look at South Korea's stock market, the Kospi index.
Oh, it's been wild.
It's tripled in 18 months just based on massive AI demand from companies like Samsung and SK Hynix.
Yeah, the optimism is highly visible. We're even seeing The Economist running pieces praising how America's economy is just soaring, despite what they refer to as the Maggie tax.
Right.
And when you look at tech exporting nations, places like Malaysia and Singapore, their exports are absolutely surging on the back of this global AI boom. They are seemingly defying the economic shockwaves coming out of the Middle East entirely.
Well, I have to pause here and play the proxy for the listener for a second. If tech exports in places like Singapore and Malaysia are completely defying a Middle East energy shock, why shouldn't we just focus on that good news?
That's the natural question, yeah.
Isn't the market actually right to follow this massive AI boom? Real wealth is being generated.
So the market isn't wrong to price in the AI boom. The error is in what the market actively ignores while it prices that in.
Okay, what are they ignoring?
Well, a sovereign credit analyst's real job isn't to just cheerlead the good news, is to identify what is fundamentally changing under the hood. So while the market was pricing in diplomacy and AI this week, 3 major governments, India, Indonesia, and Turkey, made highly unusual, very direct public admissions.
Which is where the dispatch gets its name.
Exactly.
Yeah.
They essentially announced that their foundational economic frameworks are no longer functioning.
And these are the exact frameworks the International Monetary Fund, the IMF, relied on to model the global economy.
Precisely. And this brings us to a concept in the dispatch called institutional permanence.
Okay, break that down for us.
The market has this psychological tendency to assume that the IMF's baseline projections, specifically their April 2026 baselines, are permanent constants. They treat those economic models like the laws of physics.
But I'm guessing they aren't physical laws.
No, they aren't. They are contingent equilibria.
Hold on, contingent equilibria sounds like something out of a graduate physics textbook.
Mm,
Are you basically saying the IMF built a house of cards and modeled their financial projections on the assumption that the wind would just, never blow?
That is a very accurate way to visualize it, yeah.
Yeah.
An equilibrium only holds up as long as a very specific set of temporary conditions remain perfectly balanced.
Right.
The good news in the tech sector is real, but it's acting as a very shiny distraction. It masks the rot in the foundational assumptions of global debt. The market is pricing in the optimistic deals, but they're completely ignoring the admission that the wind is already blowing the house down.
Wow. Okay, let's look at the first massive admission because this one has immediate real-world impacts for literally billions of people.
Yeah.
We're talking about the Iran war energy shock breaking right through national defense mechanisms.
Yes, this is huge.
Over in India, Prime Minister Modi just publicly admitted that he can no longer shield his citizens from the energy cost shock of the Iran war.
This is a monumental shift in policy.
Yeah.
And in economic reality. What we are seeing is the explicit retirement of a massive sovereign buffer.
The shield is gone.
Exactly. The IMF's April 2025 balance of payments model for India was built on this core assumption that the government would aggressively manage domestic fuel prices. That managed price regime was a financial cushion.
It stood between the volatile international oil price and the actual purchasing power of the citizens, right? In the world's most populous nation.
Yeah.
So the government was essentially eating the cost difference to keep the economy stable, and Modi just stood up and said, the cushion is gone.
He publicly retired it. And we need to understand the mechanism of what happens next. When that buffer is removed, the import costs pass straight through, completely unmediated, to domestic prices.
Ouch.
Yeah. The government stops subsidizing the barrel of oil, and the citizen pays the true global premium at the pump. And we are immediately seeing the real-world friction of that policy shift.
You're talking about the viral youth unemployment protests across India right now.
Exactly. The deterioration has moved from abstract financial spreadsheets into the real economy, directly impacting social stability.
To bring back our earlier analogies, it's like a city's levy system. The IMF built its economic models for these countries, assuming the levy would hold back the floodwaters of the Iran war indefinitely.
They did.
They priced the global real estate based on the absolute certainty of that levy holding, and Modi just grabbed a microphone and announced that the levy is gone, the water is actively rushing in.
And if we look geographically elsewhere, say to the African frontier markets, we see the exact same structural issue playing out even more violently. In countries like Kenya, Mozambique, and Comoros, their version of the levy was the sovereign fuel subsidy. They were subsidizing international diesel and petrol prices specifically to keep their domestic economies functioning.
And those sovereign subsidies have now broken as well.
Completely exhausted or withdrawn.
Yeah.
And just like in India, the downstream consequence is immediate. We are seeing violent fuel price protests spreading across these nations as the true cost of energy hits the consumer overnight.
Now, the dispatch notes something really fascinating about the timeline here. The IMF actually did anticipate that Kenya and Mozambique would need to reform these subsidies eventually.
Right, it was written into their conditionality requirements.
So if they knew it was coming, why is it causing such absolute chaos right now?
It comes down to sequencing and speed. The IMF modeled a controlled, sequential phase-out of these subsidies over several years.
Oh, so a gradual easing.
Exactly, a managed adjustment that the economy could absorb. But what the Iran war did was force that reform at a violently accelerated pace. The shock happened instantly.
And the models couldn't handle it.
The IMF sequencing model simply never accounted for a macroeconomic shock of this magnitude, forcing the buffer to evaporate overnight.
If you are listening to this and wondering how bad an overnight shock can be, imagine your gas prices doubling by tomorrow morning just because a foreign conflict broke a government spreadsheet.
It's terrifying.
But it's not just a domestic problem. There is this invisible vice squeezing these developing countries from the outside at the exact same time. And it starts with a seemingly totally unrelated piece of good economic news over in Japan.
Yeah, this is perhaps the most underappreciated dynamic in the global market right now. Japan's Q1 GDP came in solid. It was a demonstrably strong print.
Which on the surface sounds great, right? A strong economy in Japan should be positive news.
Positive for Japan, sure, but potentially devastating for developing economies. We have to follow the mechanics of the debt here. That solid GDP print further cements the trajectory for the Bank of Japan, the BOJ, to hike their interest rates in June.
Okay, and why does that matter to a protester in Kenya?
We have to look at how global sovereign debt is funded. For a long time, we've had this mechanism called the carry trade.
Let's break down the carry trade, because it sounds like opaque Wall Street jargon, but it's basically just international arbitrage. Can you walk us through the actual mechanics of it?
Absolutely. Because the Bank of Japan has historically kept its interest rates incredibly low, near zero, or even negative for years, global investors could borrow money in Japan very, very cheaply.
Basically free money.
Right. And they would take that extremely cheap borrowed yen, convert it, and invest it in sovereign debt in countries offering much higher yields. We're talking about bonds in countries like Kenya, Ethiopia, Pakistan, and Egypt.
So to put it in everyday terms, it's like borrowing your neighbor's credit card that has a 0% interest rate and using it to buy a high-yield savings account paying 8 or 9%.
Yeah, pretty much.
You pocket the massive difference, and it's essentially free money as long as nothing changes.
Exactly. As long as the BOJ maintains its highly accommodative, low-rate policy, the math works perfectly. But that accommodation is now closing in a straight line.
Because of the strong GDP print.
Right. The solid Q1 GDP means the BOJ is normalizing their economy. They are raising rates. So the cost of that borrowed money in Japan is suddenly spiking. The investors holding that debt are facing a margin call.
Let me see if I have this right. For a country like Kenya, you are getting squeezed from both sides simultaneously. Domestically, the levee broke, gas prices are exploding, which is causing mass protests and instability in the streets. And internationally, the credit card your country uses to keep the government lights on, which was funded by that cheap Japanese money, just had its interest rate radically spiked.
That is the invisible vice. You have a massive domestic political shock colliding head-on with an external financial carry shock. And here is the crucial, alarming takeaway from the dispatch.
Lay it on us.
Neither of these simultaneous shocks were calibrated into the IMF's fiscal assumptions. The spread, which is the risk premium investors demand to hold these foreign bonds, has not widened to reflect this new, highly volatile reality. The market is entirely mispricing the systemic risk.
Because the market is still staring at the smart fridge while the basement floods.
Exactly.
So far, we've looked at countries buckling under external pressure, like the Iran shock or Japan's interest rates. But what happens when a government intentionally takes a sledgehammer to its own foundations?
That brings us to Turkey and Indonesia.
Yeah, the dispatch says Turkey is experiencing a compound sovereign credit deterioration with no precedent in this cycle. What does that actually look like on the ground?
It means they have actively broken two foundational pillars of their IMF program in the span of just 2 weeks.
Wow.
For the IMF's economic model in Turkey to function, it relies on two anchors: monetary credibility and political legitimacy. First, the central bank broke the monetary anchor. They formally abandoned their 16% inflation target and hiked it all the way up to 24%.
Wait, going from 16 to 24% is not an adjustment. That's a massive surrender.
It completely shatters the disinflation path the global market was relying on. And then the very next week, the political anchor broke.
What happened?
A domestic court ousted the leading political rival to President Erdogan. Now, strictly from an economic perspective, regardless of the politics, an event like this triggers immediate severe instability. It caused massive capital flight.
Let's explain the mechanics of capital flight, because it isn't just a scary headline. What physically happens in the Turkish banking system when that political anchor breaks?
Well, when foreign investors see that level of political risk introduced overnight, they immediately liquidate their lira-denominated assets.
They just bail.
Yeah, they sell their Turkish stocks and bonds, convert the lira back into euros or dollars, and pull the money out of the country. This floods the market with lira, causing the currency's value to plummet.
And the government has to step in.
Right. The government is then forced to burn through their own foreign currency reserves just to buy up lira and keep the currency from entirely collapsing. It's a rapid drain on the nation's actual wealth.
So the investors who bought Turkish bonds bought them assuming the central bank had a handle on inflation, and the political situation was stable enough to keep the economic reforms going.
Both of those assumptions are now demonstrably dead.
But Turkey still has a maturity wall approaching, correct? Explain what that means for their debt.
A maturity wall means a massive chunk of their external national debt is coming due for repayment all at the exact same time. They can't pay it off in cash, so they have to refinance it by issuing new debt.
But refinancing requires people to actually want to buy the new debt.
Exactly. It requires market confidence and stability. The debt hasn't moved, but the stability required to actually roll it over is gone. Yet, if you looked at the sovereign bond markets today, They haven't repriced this compound break. They're still trading as if those monetary and political anchors are firmly secured.
That is a staggering disconnect. Let's pivot to Indonesia, because they're rewriting the rules in a totally different but equally structural way.
Oh, this is a fascinating case study.
They just announced a state enterprise monopoly for palm oil, thermal coal, and nickel exports. Now, I have to push back on the dispatch's analysis here.
Okay, let's hear it.
If I'm Indonesia and I have all this incredibly valuable coal and nickel that the world desperately needs for EV batteries and energy, isn't nationalizing it a massive power move? Why is consolidating your best assets viewed as bad for sovereign credit?
It's a very logical question, and it's exactly how the global market initially misread the situation. They treated it merely as bold industrial policy. But to understand the hidden structural risks, the dispatch uses what it calls the Milo framework.
Wait, the Milo framework? Are we talking about the chocolate malt drink, or is this an acronym I should know?
Huh. No, not the drink. It's simply the shorthand the dispatch's authors use for their market intervention model. It's named after the lead sovereign credit analyst who developed this specific risk matrix.
Got
The IMF modeled Indonesia's economy, and crucially, its ability to generate tax revenue to pay its sovereign debts based on a competitive private sector, open market pricing system.
Which is gone now.
Right. By shifting all of these commodities into a single state enterprise monopoly, the government introduces three massive distortions that the market is completely ignoring.
Okay, so what are the three blind spots the market is missing?
The first is transfer pricing risk. Let's look at how it works. When private companies export coal or nickel, their goal is to get the highest price possible on the open market, and the government taxes a percentage of that high price.
Makes sense.
But a state monopoly doesn't always act with economic efficiency. It often acts politically. The state might decide to sell these vital commodities at a massive discount to preferred bilateral partners or political allies. If they sell it cheap to a political friend, the taxable profit is near zero. The state loses the fiscal capture, which means they lose the very tax revenue the IMF was counting on them having to pay back their sovereign debt.
So the natural wealth of the country gets siphoned off for political favors instead of paying down the national credit card. That drastically changes the math. What is the second distortion?
International trade friction, particularly regarding sustainability standards.
How so?
Let's look at palm oil. Accessing the highly lucrative European Union market requires strict private sector sustainability ESG certifications. Private companies have the infrastructure to prove exactly where and how a specific batch of palm oil was farmed.
Right, a paper trail.
But when you roll all of those independent farms into a giant, opaque state monopoly, it mixes everything together.
Yeah.
It deeply complicates or even breaks those certification chains. They risk losing access to premium European markets entirely because they can no longer prove the origin of the product.
Oh, wow. So they might have a warehouse full of the product, but nobody in Europe is legally allowed to buy it.
Exactly. And the third distortion,
Lay it on us.
it's the most foundational one, operational inefficiency. Historically and structurally, private exporters systematically outperform state enterprises on cost controls, logistics, and timing.
State monopolies are just naturally more bloated.
Inherently less efficient, yes. So when you combine transfer pricing risk, trade friction, and operational inefficiency, you realize this isn't just a nationalistic power move. It is a structural shift that introduces massive, unpredictable variance into how much revenue the Indonesian government will actually manage to collect.
And once again, the people buying Indonesian bonds right now are pricing them based on the old, highly efficient private market model that literally just ceased to exist.
Exactly. The bondholders' question shouldn't be whether this state monopoly is a good political move for Jakarta. The question is how much fiscal revenue vanishes in the transition. And the current market spread does not price in that vanishing revenue at all.
We have covered a massive amount of ground today. We've gone from the youth protests over fuel in India to the unwinding of the carry trade in Japan to the intentionally broken anchors in Turkey and the nationalized nickel in Indonesia.
It's a lot of moving parts.
It is. What is the grand synthesis here? What's the core underlying mechanism driving all of this?
The core lesson is that financial markets, and humans in general, have a really dangerous habit of trusting the map over the territory.
Okay, I like that.
The IMF drew this intricate map of the global economy with certain supposedly permanent features. Turkey's inflation targets, Indonesia's open markets, India's energy buffers. The market priced trillions of dollars of investments based on that map.
But the territory changed.
This week, the actual territory changed. The governments themselves publicly announced that those foundational features are gone. Yet, sovereign bonds are still yielding steady premiums based on absolute confidence in safety nets that have already been publicly retired.
It is a staggering disconnect between reality and the spreadsheet. And if you are listening to this right now, whether you're managing a global portfolio, running a business, or just trying to understand where the world is heading, there's a massive takeaway for you here.
Absolutely.
You always have to step back and verify if the foundational assumptions of your own plans have been quietly dismantled. Are you so distracted by the deal optimism of the day, the flashy AI news, the hope for a quick geopolitical resolution, that you haven't noticed the structural pillars falling away beneath you?
That is the vital question we all need to be asking. And if
Mhm.
we connect this to the bigger picture, the source data leaves us with a rather profound, almost chilling thought to ponder as we look ahead.
We always love a provocative closing thought. What is the data pointing toward?
Well, we noted earlier that nations like Malaysia and Singapore are surging economically due to tech and AI exports, completely defying the global shocks.
Right.
Meanwhile, massive energy importers like India and Kenya are literally fracturing under the strain of fuel costs and uncalibrated models. The data suggests we might not just be looking at temporary market volatility or a rough quarter here.
What are we looking at?
We may be witnessing the dawn of a permanent, brutal bifurcation in the global economy.
A completely new structural reality.
Quite possibly. A world where a country's survival and economic stability are no longer anchored by IMF rescue programs or historical trade relationships. It may simply boil down to a harsh binary reality.
Which is?
Do you export technology or do you import energy? The former thrives, generating massive wealth. The latter deteriorates into social unrest. This divergence isn't just a compelling narrative. The mechanism for it is written right there in the export data we're seeing today.
So to bring it all the way back to the beginning, well, before you go all in on that shiny new smart house, you might want to stop looking at the automated lights, go down into the basement, and make absolutely sure the previous owner didn't take a sledgehammer to the load-bearing walls.
Highly recommended.
Because right now, a significant portion of the global economy is standing on a whole lot of empty space. Something to think about.